Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of finance. And in this episode, I'd like to talk about industry super fund returns for the financial year ending June 21. Some important considerations, and also I will share the two industry funds that I typically recommend to people. So the two that I think are the best. So last financial year, so the 21 financial year, was the second best year in terms of returns since superannuation, compulsory superannuation began in 1992. And you should expect something north of 20% in terms of returns. So it's been a really great year. Now, whilst I don't want to sell this as bad news, because of course it's not, they're great returns, there are a few important matters that you absolutely must be aware of if your superannuation is invested with an industry super fund. Okay, so before we get there, let's talk about the best returns for 2021. So what I did is I compared returns of the 8 largest industry super funds, mainly because I recommend industry super over retail products typically. So, you know, whether it's BT or AMP or some of these sort of, or Colonial, those sort of retail products tend to be underperformers. And industry super funds tend to do much better and typically have lower fees as well. And so I picked the 8 largest funds just because they're the probably the most common fund. And the winner is for a balanced investment option was Hostplus. Now, this is not Hostplus's index balanced, which is an index style option that's often promoted by Scott Pape, who's the author of Barefoot Investor. Now, that book sold over 2 million copies, so a lot of Australians are aware of that book. And Scott is a big promoter of Hostplus's index balanced option. That's not what I'm talking about. I'm talking about their traditional balanced option, and I'll talk about the index options a little bit later on. So they performed the best out of those 8 funds, 21.3% in terms of total returns. And now, if you look at returns over 3, 5, 7, and 10 years, AustralianSuper's balanced option performed the best. And AustralianSuper last year was 0.9% less than Hostplus. So, you know, it's impossible, I think, or unrealistic to expect to invest in a super fund and they be the top performer each and every year. In fact, you probably don't want them to do that because it means they're really chasing returns. And the question is, at what cost? But, you know, it's really longer term returns are more compelling in my view. I have selected the balanced investment option, which really means, by definition, they have between 60 and 75% of total assets invested in what's called growth assets. So shares, could be Australian international shares, private equity, and smaller companies, emerging markets, those sorts of things. Now, some of those investment options are actually named growth or balanced growth. They all have different names. So it's just a bit of a warning. Don't just go off the name. Like if it's balanced and you're comparing, say, a balanced at CBUS, for example, versus a balanced at AustralianSuper, you're not comparing the same investment asset allocation. So it's really important to really look behind the actual name and have a look at the asset allocation and ensure you're comparing apples with apples. I have a link in the blog as well to a table that compares the best returns for growth, but Hostplus won that one as well. So, and also there is another link in the blog to its Chant West's website, which is a research house, and they've listed the top 10 super funds across the board. So that's small and large industry funds and retail funds, but there's no real new news there from that table. But those links you can find on the website and obviously in the show notes as well. Now, of course, it's common sense to understand where your money's invested, and that is always true whether you're investing outside super or inside super. So, I mean, it's your money, it's your risk. And my advice wouldn't be to invest blindly. That is, just give your money to AustralianSuper and not have any concern or consideration to how and where it's invested. That sort of approach will lead to disasters typically. It's really not prudent. You really need to broadly understand how is it invested, who's looking after it, what are the mechanisms and so forth. And if you're not willing to go into that level of detail, then I'd say go and pay for advice, because you've got a lot of money invested, and if it's invested well, it will generate a lot of money for you. But obviously the alternate is true as well. Now, my major concern with the industry super funds is they have an asset class which they call alternative investments, and it's really just a bit of a black box. For some industry funds, they're quite detailed in their disclosure. Well, I wouldn't describe it as detailed, but at least they give you some level of detail of what alternative investments includes. But a lot of those industry funds, you have really no idea what's invested in it. Now, alternative investments as an asset class could really include anything that couldn't be described as a traditional asset class. And the traditional asset class would be Australian or international shares in developed markets, bonds, property and cash. So if you can't put it in one of those categories, then it falls into the alternative investments category. And then it can include infrastructure investments, construction and private credit, which means borrowing, lending to those people, hedge funds, private equity, currency, commodities, like it really is anything. And that's the big concern, right? Because you just don't really know what they're investing in and what the risk profile is and what the performance is and those sorts of things. It's quite opaque. And the disclosure requirements are pretty ordinary as well. Like, I know that the government's trying to improve disclosure requirements, particularly of unlisted assets. But obviously the industry funds are pushing back on that. Now, if you have a look at the allocation to what's called alternative investments, it can really range between those top 8 funds between 5% and 33%. So a third of your money is going into this pool that no one really knows anything about, and that industry super funds have very little obligation to disclose. Included in alternative assets could be what's called unlisted assets. So the advantage of listed assets, and listed assets are, assets that can be bought and sold on an exchange. So typically like the ASX, Australian Stock Exchange, or the New York Stock Exchange, London Stock Exchange, etc., they're listed assets. One of the advantages of investing in such assets is that price discovery occurs on a daily basis. Now, price discovery means that you've got a market, an open and transparent market, where you've got buyers and sellers, and that the current prices of the investment reflects all publicly available information in respect to that stock, and also reflects the market's views on that stock. So it's a really transparent process that gives you a very current idea of what your investment's worth, what the risks are, and consequently how it's performing. However, if you have unlisted assets, you obviously don't have that liquid, transparent market to rely upon. Now, an unlisted asset can include, an investment in a really large infrastructure project, or an investment in a company that's not listed. So that's what's called private equity. And essentially, if an industry fund invests in something like that, they have to independently revalue those assets periodically. Now, prior to starting ProSolution back in 2002, nearly 19 years ago now, I used to work for one of the big 4 chartered accounting firms in Deloitte, preparing business valuations, and I know all too well that valuations can be highly subjective. And the fact is that you never really know what an asset's worth until you go and attempt to sell it in an open market situation. And some commentators have suggested that industry funds are using the subjectivity of unlisted asset valuations to their advantage by allowing them to manipulate investment returns. It's called valuation shopping, which means that you go around and speak to a bunch of valuers and try and get their opinion. Now, I'm not suggesting this is what's happening, but obviously if you're running one of these industry super funds, returns are important. Returns are important in respect to you retaining your job, to having a thriving industry fund, and there is a conflict of interest here although there's a lack of disclosure. And that's the problem here. Now, the government's trying to fix that. The industry funds are currently pushing back on that, of course. But, bad returns hide in the dark. And where there's no dark and there's complete transparency, bad returns won't, or poor returns or unacceptable risk just cannot persist. Now, it's probably a reasonable question to ask ourselves, why do industry super funds invest in these unlisted assets, invest in these alternative investments, if you like? Well, one of the challenges that industry super funds have is they've got a lot of money to invest. Now, the superannuation guarantee rate increased to 10% of your salary after 1 July. That will rise to 12%, and that's a lot of money flowing into the super funds. For example, I don't have 2021 information, but in 2020 financial year, AustralianSuper received $15.5 billion in terms of new monies to invest. They've got to find a home for that money. They've got to find somewhere to invest. And it's a problem because, particularly in the Australian market, the Australian share market is so small that an industry fund can end up moving prices if they start buying particular stocks or in particular sectors and so forth. And so one alternative is to look for unlisted assets that they can invest in. Now, that's an industry super fund's problem. It's not your problem to adopt, right? Just because they've got a lot of money to invest doesn't mean that you should make any compromises. And I would argue, in fact, that and there's some good examples like UniSuper, for example. Most of their investments in their balanced option are invested in assets that are mostly listed. And so I think that creates a lot of transparency, and it gives me a lot more comfort about what the true performance, the true underlying performance is, and it leaves less ability for a super fund to manipulate returns. And you can argue that I'm being highly skeptical, and I probably am, but I'm reminded that there's been lots of situations or events, corporate collapses, people getting ripped off, Ponzi schemes, all these sorts of things that at the time didn't seem like a major concern, but was found out to be perpetrated via commitment of major fraud. And fraud just can't happen, or at least the risk is much, much lower where you have absolute transparency in all investments. And I think that's just got to be, something personally that I would always require in the way that I invest monies. Okay, so let's talk about the best industry funds then. So the way I would, or the three considerations I have when selecting an industry fund is, of course, historic investment returns. Doesn't necessarily mean that they will continue to outperform, but the reality is, at least over the last 10, 15 years, that there are a handful of industry funds that tend to continue to outperform the market, or their peers, I should say. So returns are one, fee levels are another. Fees are certain, returns are uncertain. So using a fund or selecting a fund that has lower than average fees, as long as they've got higher than average returns, feels pretty smart to me. And thirdly, I should say, I don't want a lot invested in alternative assets, because at this stage there's just not enough disclosure requirements, which increases the risk of that investment because I can't really assess its risk profile and performance and so forth, and therefore I'm less inclined to invest. So they're the three criteria that I use. And there's two funds that really stand out. The first one is AustralianSuper. Now clearly it's been the better performer over 3, 5, 7 and 10 years. Its fees are relatively low. It charges 0.63% for its balanced option. That's an investment fee. It's got some admin fees as well, but that's the investment fee. And it's got 7.5% invest in alternative investments, but that's mainly in infrastructure and direct property, and I'm pretty comfortable with infrastructure and direct property. It's all the other stuff that I'm mostly concerned about. So Aussie Super is a good option. And the second one is UniSuper. Now, UniSuper used to be only available to people that were employed by Australian universities, but as of 1 July, it's opened up to the public now, so that's great. It only invests in 5% in alternative assets, which include infrastructure and private equity. 5% I'm very comfortable with. Its fees, investment fees, are lower than Aussie Super at 0.46%, so less than 0.5%. That's very low cost in terms of fees. And its investment returns over the long run have been excellent, just slightly below AustralianSuper, but not materially below. So Aussie Super and Uni Super are really the two best industry super fund options. Now, that's not to say you should move your super monies there. Of course, I have no idea what's right for you, and this is just a generalisation. In fact, there could be far superior options. So, for example, I've had my super invested using a wrap platform for probably 20 years now, and I use this for a lot of my clients also. And I think it's a superior, more transparent way of investing that gives me as an advisor a lot more control around exposures and so forth. Now, anyone that's been listening to this podcast for a while will realise that I'm a huge fan of low-cost, evidence-based, rules-based investment methodologies, particularly when investing in share markets, such as indexing and so forth. So it's probably reasonable for you to expect that I would be a fan of the index options that industry super funds offer. So quite often you can have two options, a balanced option or an index balance option, and the index balance option has a whole bunch of index funds behind it. Well, I've compared the historic returns, and mostly over most periods of time, the index option has underperformed its traditional comparative option. So it suggests actually indexing isn't really working in the super funds. Vanguard used to run a lot of their index portfolios, but it's withdrawn because it's going to release a retail product, which will be fantastic for Australians, by the way. And I'll be talking about that when it comes out, when we have more detail. But so now they have to run it themselves, and they're not going to run it as well as Vanguard has. I'm reminded by a really good quote by Upton Sinclair, which was an American novelist. And his quote says that it's difficult to get a man to understand something when his salary depends on him not understanding it. And my concern with, again, perhaps being overly skeptical, but my view is that if the indexing works in industry super funds, they won't need anywhere near the number of investment staff. In fact, if it works really well and they promote it well, perhaps they end up having to lose, maybe 20, 30% of their staff, because to run an index portfolio is very low cost and doesn't need a lot of human resources. So firstly, the investment team, their jobs are on the line. If their index portfolio works well, maybe they won't have a job. And then secondly, obviously industry super funds have very close tie with unions, and unions aren't big fans of redundancies. So really there is a conflict of interest here, because the people that are running that money, the people that are making those investment decisions, are incentivized to make sure that their traditional balanced option performs better, and that indexing doesn't work. And that's why I think that's what I'm saying here, because I know I run index portfolios for my clients, and they've outperformed industry super funds. So they're obviously not doing it properly or very well, or they're manipulating the asset allocation. But either way, I think you've got to back the horse that's most likely to win. And so I would stick to the traditional investment options, which quite often there's sort of two options that you typically have with an industry super fund. There's what's called a pre-mixed option, so a balanced growth, so forth, or you can mix your own option using investment asset classes. So you can decide how much to invest in Australian shares, international shares, and so forth. My strong view is to let the investment professionals make those asset allocation decisions. Asset allocation decisions are incredibly important. It's important that it's monitored regularly and changed regularly. And they have investment committees to make those decisions that receive a lot of advice from asset consultants and so forth. You're paying them a fee, let them earn that fee, by making that most important asset allocation decision. So stick to the pre-mixed options. Choose either balanced or growth or something like that, whatever's appropriate for your risk profile. Don't try and do it yourself by deciding, Australian shares or international shares or whatever. Particularly if you have done that and it's worked incredibly well for you, because it might have over the last few years. It's not going to be the same. It's not always going to work so well for you in the future. So there you go. That's sort of sums up 2021 returns, superannuation returns. The key elements: make sure you choose a really good fund, good returns, low fees, less exposure to alternative investments. Stick to a pre-mixed investment option, balanced or growth. Stick away or avoid the index options because they're likely to continue to underperform for all the reasons that I've just outlined. Okay, that's it from me for this week. Until next week, bye for now.